G'day, Justin Hockey from Right Source. Getting close to Christmas, time to take some annual leave and possibly shut down, get all your employees to have a break. And I know some business owners go, well, how much is this costing me? And Christmas is a quiet time for some businesses. For some businesses, it's actually a very busy time and can be costly from a different point of view. One thing in business that is actually, there's a lot of misunderstanding in is how much an employee costs. So you'd think that would be pretty simple. How much an employee costs? Well, there should be one answer to that. Well, actually, technically it depends who's asking. And therein lies the rub. Because it depends who's asking, sometimes the answer changes. So what I wanted to go through with you guys today was a bit of an understanding of employee costs, which will also give you an understanding in terms of maybe some business modeling and charging clients and stuff, but basically an example of how you work out the different employee costs that are there in the business, so you get an understanding of, well, depending on who's asking, what answer should you be giving, but also will give you an understanding of what that employee costs through to how that impacts potentially your bottom line. So to do that, I've got a bit of a template I'm happy to share that with you. If you're interested in that template, there's a link down below. Click on the link, fill in your details, flick it, and I'll flick you through a copy of the template, and you can either work through the template together. It's a bit of management accounting, so if you've seen some of my other videos, this isn't a one-size-fits-all approach. This is to be used more to give you an understanding of what type of things you need to consider, and then be able to apply that to your own circumstance, but it does give you a starting point. So to do that today, I'm going to jump on the computer and talk you through some of the steps in terms of understanding your employee costs. Here's a template that we've built. Now there's a lot of numbers in here, but don't worry, we'll go through it step by step and I'll talk you through what this all means and how it all fits together. So basically start here on the left with the assumptions in terms of, well, how much are you paying your employee? So I like to talk in annual figures rather than in hourly dollars, but what's your annual equivalent? So are you paying them, what's their take-home pay? So, and this is what the employee, so this first one is what do the employees believe they're getting paid? So when you talk to your employee, what's the amount they're getting paid? So for example, say we've hired someone that's getting paid $65,000 a year. So $65,000 is what they're paid. It's what they have in their head as their salary or their wage. Now the other things that you need to have in your assumptions to work out your cost is, are there any allowances that you give your employee? So for example, do you give them a phone? Do they get a t-shirt? What is it this is more monetarily, so they get funds to purchase these things. So for example, say you give them $1,200 a year to go and purchase their own phone. So that way they supply the phone, but you give them an amount to go and do that. Then beneath that, we've got other direct costs. Now this is where you as an employer might pay for their shirt or pay for their stationery or pay for their laptop or pay for something like that. Now, you can put figures in here. I prefer not to. I prefer to keep it very clear in terms of it's money we're paying the employee, not stuff we're giving them. But this is where things are flexible and this is where you can adapt it to your own way. And as we work through this, you'll see how that can apply. So at the moment, I'm gonna leave that blank. The rest of this down here then is about their employee conditions and how they're working. So the hours per week we've got is 37.5 because that's the normal weekly hours they're going to do. They're a full-time employee. Their super, their entitlements, how much we pay for work cover insurance, payroll tax. If you have enough employees, you have to pay payroll tax. A little bit crazy, but that's one of the taxes that are out there. Also, if there's casual loading, so if they're a casual employee as opposed to a permanent employee, they might have a casual loading that they're entitled to as well. Then below that is their leave entitlement. So if they're not casual, permanent, how many days leave do they get for annual leave, for personal leave? And then below that, how many public holidays they get? Because guess what? Employees don't have to work public holidays. I know as a business owner, that seems crazy to me too. Every day is a work day, but employees, public holidays, you don't need to work. So you need to factor that into your costing. Then lastly, which I'll explain a little bit as we go further into it, how how well utilized that employee is. So that utilization is of the time they spend, how much time are they doing actual revenue producing work? So work that helps the business deliver its products or services. And lastly, the marginal markup you want to put on the costs to charge to the client. So that way, at the end of this process, we'll actually see, given an employee cost, what would their charge out rate be as an estimate. So that's the first column, the assumptions. Next, we work through, well, okay, how does this then play out in terms of employee costs? So at the top line there, we've got wage paid. So we've got the $65,000 a year, and we've converted that to an hourly rate as well. Because some people like to know, well, for 65,000, how much is that per hour? So that's there in the model. Then what we work through is, okay, these other costs, super, work insurance, payroll tax, casual loading, allowances, direct costs, all these costs are costs you as an employer have to pay for your employee. So if you work through all those costs on an annual basis, you get back down to, well, this is what they actually cost as a full cost of, or sorry, as an employment cost paid. That's the employment cost you pay as an employer to have this employee. So for a $65,000 employee, that works out at $74,500, or an hourly rate of $38 an hour. So is that the cost of my employee? Well, not completely. That is your full cost. That is what's used in terms of reporting costs, but there's more to it. Hence the confusion and the different numbers that might get spat out in terms of employee costs. So the next thing you need to look at is, well, how many days are my employees working? And so this is then the next column. A little confusing, stick with me. Work days in a year, 260 work days a year. So that's 5 days a week for 52 weeks a year, 260 days. That's how many days they could work as a full-time employee. So again, if their hours are different and you've set up your assumptions differently, you have to work out how many hours they're working. Now, from those hours, let's assume that they take all the annual leave, all their sick leave, and they obviously don't work the public holidays. That then works back down to 220 days that they are available to work. So not the 260 days, not every day in the year, but only 220 days of the year are they available to work. So if we take that 220 days and we take how much we're paying to have that employee being 74.5, what this does is allows us to equate back a cost per hour worked, or a full cost based on the days available. So that now works out at $45 an hour. So for those 220 days that an employee works, based on how much they're paid, they cost you $45 an hour. Now, you're paying them $33 an hour, but they cost you $45 an hour. This is where it's important to understand what you're talking about when you're talking about employee costs, because that's a bit of a difference. But that's not the end. Next, when we're looking at utilization, so of those 220 days an employee works, they're not working 100% a day on delivering a product or providing a service. There'll be training, there'll be meetings, you need to have lunch, there'll be general discussions around the office, collaborating with others. Not all of that is actually directly attributable to creating the product or delivering the service. So this is where you need to take utilization into account. So I've used in this model 80% utilization. That is pretty high. Much higher than that is unusual, and generally speaking, it's usually lower than that because it takes time to be able to plan your work out. It depends when customers are available. There's a lot of moving parts in making people utilized. It's also, on the flip side, one of the areas of a business, if you can have high utilization of your staff, you'll drive much better profitability. In understanding utilization, then we've got 80%. So that means of the 220 hours that they're working, using that 80%, only 176 of those hours are actually doing revenue producing work. So if you use that 176 hours, still based on they are paid $74,500 in terms of their total cost, that's what you're paying them as an employer. The cost to use an employer for those revenue producing hours equates to $56. So $56 is your fully utilized cost. Now, this one is really important because this is the cost of producing the work that you do to your customers, to your clients. When you're looking at profitability, this is the cost that you use. And so the final step in this model is going, well, if that's the cost of delivering the product to my customer, how much profit do I want to make? Now, it's not just profit, and this is where I come back to those costs that I like to not get too crazy about the direct cost. This profit you want to make should cover not only you as a business owner, the profit you want to make on your business, but also covering all those overhead costs. So the cost of an office, the cost of your vehicles, the cost of electricity, those type of things that is very hard to associate with an employee. Where I see people coming undone is where they try and allocate too much to the employee, and it's not actually the employee that's driving those costs, so you can get a wrong result and therefore make not the best decisions of it. So my view on this is, this takes a bit of time to work out what your markup should be, because you do need to take that back in terms of your profit and loss and understand, well, if my markup's this, what's the effect on my profit and loss? That's all part of the process and part of the learning as a business. But this model will allow you, if you know what that figure is, you'll be able to put that into this spreadsheet, and then basically it works out then, well, based on the cost of your employee, what should you charge your client? So for example, in this one, I've used 15% as my overhead and profit. That gives me a charge rate per hour of $65 per hour. And at that rate, given the hours that employee will be utilized, I would be charging $85,000 out based on a cost of 74. Now, that's information. That's not what you have to charge. You could charge more, you could charge less. This is just giving you an idea of what those figures look like. That's it, that's the model. We've gone from an employee cost, a wage paid of $33 an hour or $65,000 a year, down through to a fully utilized cost of $56 an hour, which is nearly double, to a charge rate to a client or a billing rate of $65 an hour, which is double. So there's a large disparity in there. So why I'm saying it's very important to understand when you're talking about employee costs or employee charges, it's very important to understand what you're talking about and who you're talking to, because the number will be quite different depending on the audience. So that's basically a model. Again, if you would like that example, it's not a one size fits all. It definitely needs to be customized and fit to your business, but it's a starting point for you to start to understand the vagaries of employee costs and how it impacts your business. So if you like it, subscribe. Also click the link below and put your details in. I can flick you a copy of the template. Plus there's also other templates you can get on the YouTube channel. So look at some of the other videos I've got. Incremental budgeting is a favorite at the moment. Otherwise, I'll see you guys next time, and it's Justin Hogg from Right Source. Talk to you later.